All right. Welcome to back to the DFL podcast. Today we've got Trevor Bacon. He's the co-founder and CEO of Parcl, blockchain-based platform that lets users invest in real estate price movements through on-chain indices rather than owning individual properties. He also leads Parcel Labs, which supplies the real-time housing data that powers the protocol. Parcel's platform aims to democratize real estate investing by allowing anyone to trade exposure to city-level real estate markets with low minimums and transaction fees. Trevor, welcome to the podcast. Thank you so much for being here.
Thank you for having me and us. Appreciate it.
Yeah, no, absolutely. Well, I know I gave a quick background, a little bit about what you're focused on today, but if you could, in your own words, just a minute or two, just give me a little bit about your background, your kind of career, and what you're focused on right now.
Yeah. So my background Parcel and Parcel Labs were started in 2021, so about 4 years ago. Prior to that, I was a portfolio manager at a technology-focused hedge fund, investing in TMT stocks, internet software payments, communications infrastructure. I was at a larger hedge fund before, a couple larger hedge funds before that, and I started off on the sell side in the banking world at Lazard and Barclays. So went from traditional finance, mainly in technology, to the data and crypto world. So that's my background.
Okay, and now you're focused, so you moved from kind of the Wall Street to tech, and now you're focused on Parcel. Maybe, I know I gave a description of it, but maybe that was a little bit, maybe I'd like to hear
That was a great description.
Okay, all right. In your own words, snippets.
So,
you gotta get
the origin of Parcel. During COVID, there was a lot of real estate volatility, and one of our co-founders, Kellen, and I were working together at the last hedge fund we were at, and we wanted to create a way in which you could gain exposure to real estate without owning the underlying asset itself. Obviously, buying a property is very capital intensive. It takes a long time. And if you think about during COVID, the obvious trade was to buy in Miami and sell in New York, long Miami and short New York in kind of trader terms. There was really no way to do it. So we were trying to figure out a way in which to give liquid exposure to real estate markets, both directions, long and short. The first problem we had to solve was creating live real-time price indexes. And that's when we tapped the third co-founder who I knew from growing up, Jason. And that was the beginning of Parcel Labs, which is our real-time real estate intelligence, analytics, and pricing engine. So that's effectively what we've built. I'll say on the exchange side, we're on our third version now. The product we call Deal Flow, and the point is to give people exposure to real estate. And we've done about $5.5 billion of transaction volume over the last 2 years. We continue to iterate on the exact right instrument to bring it to market. The current version we have did a great job. We're going to continue to tweak and see how we can make it even more efficient to scale the market. And on Parcel Labs, again, it powers the protocol in terms of real-time prices, but there's also a lot of content that comes out of Parcel Labs and a lot of information around pricing at a national level, true ownership, trends with respect to institutional owners, iBuyers, foreign-owned entities, etc. So there's a lot going on, but it's always fun.
Okay, so it's sort of, you have two sort of businesses, but they're somewhat related in that they sort of rely on each other.
Very symbiotic, like we had to, when you think about it, it's like, okay, you're trading, the initial intent and why Parcel Labs was created was to create a trading platform for real estate. There were no, and there are no real-time prices, right? And so how do we create these real-time prices, give it credibility, trust, authority, in the sense that people would actually use these prices to put money and exposure into our system. So they're very symbiotic in that nature, and really a lot of the efforts that we make on Parcel Labs is to build that authority and trust with pure information. We're unbiased. We have no our business model is neutral. We do not rely on transactions in terms of actual housing sales or listings. So we try to be credibly neutral and provide the truest information, which in turn gives trust to Parcel ecosystem.
Sure. How do you, I have so many questions, and so we're gonna see how this. So I guess how do you because you're using an algorithm to try to approximate movement of the market, right? And so, but that is somewhat unobservable, right? The actual movement in pricing in any one day, especially given how long settlement takes, and just the fact that I assume your algorithm is grabbing data, and even that data is an abstraction of what's actually happening. So how do you kind of get as close as you can to that approximation? I know you said you have several kind of versions of your engine. Maybe can you speak a little bit about that, and how you approximate that, market movement?
Yeah. So for a lot, I would say a lot is just the prices of homes and the listings, but that's the spot market. So our goal is to be as representative of the spot market as possible. There's a methodology to it, but like an algorithm, we're not imputing anything. It's a median. We combine the sales and listings. Say the listing is like the ask, the sale. It's a little bit lagging, right? The listing is more live, but the sale, because it has to go through the county records. But it's a combination of the two, and it's a median. Okay. So we're assuming that the bid and offer, shall we say, is taken care of on the ground, and all of that gets imputed with the actual transaction or the spot market. So it's a median price per square foot for various price feeds that we have. We have every major metro for a price feed, and then we that trade on the Parcel protocol, but then we have price feeds for tens of thousands of zips and towns. But those aren't live, but they are available to view on the Parcel Labs app.
Got it. Okay. So you're not necessarily you're not taking any other types of data other than price.
Yeah, exactly. Because the assumption is that is already factored into the list price, rates, for example, or various supply and demand. That should be factored into the list or sale. So us adding another layer on top would likely convolute the actual price, or double count it.
And then presumably your market, the people in the marketplace would make adjustments if they felt like there was, if days on market are increasing or rates, have moved up quickly, right? And then that gets expressed through how they trade.
You would then
the market.
Yeah, you would then have either like an over. You'd have an imbalance in one way or the other on the market. Like if they think that our price feed is not live enough, and it should be higher, then you would see maybe like 70% of the traders are long versus a more neutral number, which is 50-50, obviously.
And then in your I know you had said there's not a lot of, or there's nobody who's really doing this sort of real-time market, but you would be competing with other people who are allocating or trying to express a view on a speculative view potentially, or maybe hedging, I guess, against risk that they have in their portfolio in certain areas. But then you would be, a substitution might be REITs or synthetic equity CDOs, or I guess a lot of people can't necessarily access certain types of products. How do you guys think about where you position relative to some of the alternatives?
Yeah, so there are a few platforms that are like fractional ownership, if you will. Our view on those is they're just naturally hard to scale because you need the capital and time to close the deal. Like every deal needs capital because you need to put it down. And then REITs, for example, they're like real estate, but they're kind of they trade more on they trade obviously with the market, right, which isn't directionally related to real estate. And then REITs, in order to grow, they need to grow and expand their regional exposure. Because once you're in one market, how do you go to the next and the next and the next? And then the bet within a REIT is not on real estate, but it's more on the operations of the underlying company. And a lot of REITs are actually types of real estate. So distribution, data centers, apartment complexes, senior living. It's not for Miami or San Francisco. Yeah, exactly. It's exposure to the operations of a certain type of real estate most often. And the biggest REITs are actually the data center REITs, which are tied to something completely different than real estate.
Right. So you're really trying to focus down on that price movement, focus on that.
Isolate real estate exposure. That's exactly what we're trying to do.
Okay, well, and it sounds like you're doing a great job at it. You've done over $5 billion of transactions through this platform or on the blockchain expressing this view. Tell me a little bit about your participants. Like who is a common person that's using this platform? And then we'll switch over to the data part of it.
Yeah.
But like who is your typical customer, and is that the customer that you had anticipated being your customer, or has that changed since you started the company?
Yeah, so we built the platform on the blockchain. It's not tokenized real estate, so it's the price movement versus USDC, which is just US dollars provided by or generated by the company Circle. They recently went public. At first when we started, crypto was a little more of the Wild West. It's coming into form in terms of more traditional adoption, maturing, people seeing the actual technology and the use case that it can bring. I would say, and prior to this new administration, crypto was very persona non grata, but that's changed. So I would say that the main users are retail. We are seeing some like light institutions, people hedging their exposure on the ground. However, over the last, call it 2 or 3 months, we've really shifted to what was once like more of like a trading platform to this deal flow platform, where the underlying architecture remained the same, but we really assimilated all the product, the way we talk about the product, and frame the product to fit the traditional real estate mold. So when you are trading, you are getting access to a deal, your trading fees or your closing costs. If in the event you were liquidated, it's your foreclosure. So there's a huge opportunity for us to morph what was a crypto, basically fit the crypto user and move it over to the real estate user, with the idea that it's easier for those people to grok what we're doing, and at the same time present a product that provides real utility to people in the US. Obviously, there's a huge real estate discrepancy with respect to affordability. And so shifting the product, trying to make it more accessible, was also in reaction to a more favorable regulatory environment. So that's what we're working through now. We want to be regulated. There is no regulation, but once we are, we think that'll open up a lot more opportunities amongst institutions and people with respect to distribution, because we're currently unregulated, but there's most likely a path that we can enter the United States with the regulated product, which will help distribution and scale.
Right now, if someone wanted to express a view on your platform, where is that distribution? Where are they able to kind of connect with you through that mechanism?
Parcel app, it's parcel.com.
Okay, so they are able to transact
you can go
that platform directly.
Yep.
Okay.
Yeah, and we're working on onboarding and currently it's like through a Solana wallet, but soon it will be through our own Parcel wallet, which will have nice cities like on ramps for people that are less familiar with how to move money into the blockchain ecosystem.
Got it. And so for that particular business, how do you, other than speculation on price movement, I imagine a lot of this could also be, especially on the institutional side, more of hedging existing exposure, dealing with, deals that are in contract and trying to lock in exposure to close, or some other sets of use cases. Where are you seeing right now? It sounds like you're seeing it more in the retail. As you move into institutional, how do you foresee or expect folks to use your platform or to get exposure? For what purpose?
Yeah, I mean, so currently retail, for the institution, we think it makes a lot of sense that basically if you assume that institutions could be a larger share of real estate moving forward, given that a lot of homes are, the affordability of homes is very high, the unaffordability, right? And so who steps in and can take share in terms of home ownership? We've seen a lot of single family rental operators are only 1% of the market today that can easily go a lot higher. And in those models, there are no ways in which you can mitigate risk from the underlying. So much like every other asset class has futures and options to hedge, we think that Parcel could provide a way in which you can mitigate risk, protect your downside in the event of any economic uncertainty. But just like airlines hedge oil via futures, or farmers wheat, corn, cows, like there's derivatives for every market except for real estate.
Sure.
And as the institutions come to market with more buying pressure, we think derivatives make a lot of sense.
Yeah, absolutely. I mean, people are already, a lot of investors are already hedging their interest rate risk and other types of risk within their, their capital structure. So it makes sense that you'd want to potentially protect against price risk. Certainly. That makes a lot of sense. So switching a little bit over to maybe the research part. So it sounds like it's a lot of the backbone of what you guys are doing. Without the research, without the underlying data, you wouldn't be able to maintain and grow this other platform. So tell us a little bit about that business and kind of where, what data and what analytics you guys provide and to what sort of customers.
Yeah. So the customers real estate data is very interesting. There's a lot of people who have their own use cases. Just stepping back, Parcel Labs is a real estate intelligence platform. We aggregate sales, listings, ownership, every event for a house, index it within our data warehouse, and then provide APIs in which you can access that. We also publish research that we find interesting, that usually other people find interesting if we write about it.
Sure.
And so there's an API available for purchase, and then a subscription to the research. So the user base is very, it is very wide. It's realtors or hedge funds or think tanks, universities, anyone that is particularly on that the API side, because they're pretty sophisticated with respect to data, and they could use the data to run their own analyses and write research or make investment decisions, et cetera. So it's a pretty wide base of users and potential use cases that we cover, but it's been good.
Yeah. And is that the business started with the idea that you wanted to do the futures exchange, or did that kind of birth out of the data analytics kind of consulting business?
Yeah, so it's one synergistic company. How
like chicken or the egg question, when you guys kind of thought it up or got.
Yeah. One it was contingent on having price feeds. So it's like, and you can control your own destiny by having your own pricing. Mm-hmm. So, there's what were the options at the time when we started in order to create a market? The case shiller, which is pretty lagged. So it updates once a month on a 2-month lag. So, it was kind of like, that's not a lot. And that was like the gold standard. And then there's other price indexes that you may or may not be able to access. They do also update usually once a month on whatever lag they have, but there's no geographic specificity or anything that, customizable that we want. So the biggest lift at first was to figure out how we can create a data system that worked for us in terms of what we wanted to offer. And it kind of grew from there in terms of the data that we ingest, the research that we offer, the API, et cetera.
Okay, cool. Very good. Yeah. So there's sort of like a gap in even just having the underlying data. And so you needed that anyway, in order to make the marketplace work. And then obviously the data is valuable and packaged up. It can be served up in different ways to customers. So it makes a lot of sense.
Yeah. It's like you can go a million, like everyone has their own way of viewing data and what they want to see, etc. So for that use, for the more sophisticated, there's an API, so you can use it and do what you want. Then we try to write the research to stimulate the ideas that we find interesting, that you could either do your own analysis via the API, or when we do write those pieces, like the media will oftentimes picks up on it. We've established a good relationship with the media to help us grow brand and authority, which we think is somewhat valuable. So that's kind of the path. And then we continue to iterate on the underlying data and making that as good as possible.
Cool. All right. Well, let's talk about the data a little bit and see what's going on these days. So, I think you said that it's been about 4 years since you started this platform. Is that right?
Yeah.
Yeah. So in that period of time, certainly a lot has happened. 4 years ago, 2021, kind of peak of the market, right? And since then, the market has definitely changed. The real estate market has definitely changed. Rates have moved a lot. Liquidity has come out of the market. Who are the buyers? Who are the sellers? That's changed. So maybe if you could speak a little bit to that, what are you seeing in today's market so far as where, and since your institutional focus, like where are institutions buying today versus not buying? Like what's the temperature? Give me kind of like if I was in the room with all of the 50 biggest buyers of real estate, single family real estate, what would they be saying? What would I be hearing from them?
Yeah. So I would say there's pockets of strength and weakness. During COVID, there was a large, the biggest market that the SFRs basically concentrated in is Atlanta. That's one of the hubs. And so we're seeing over the last, call it year, they've been kind of net disposers. I would say that there's 8 large SFRs. And a lot of them have been net disposers, but it's not crazy. So it's not like they're fire selling. They are much more, we have a motivated sellers index, which basically is an aggregation and then accumulates to a score based on time on market, listing cuts or price cuts. The weakest markets there are Houston and Miami. So Houston is and parts of Florida. So like the southern part of Florida. Those are markets that are we're seeing the most aggressive selling from these parties. Some of the more sophisticated buyers or players, shall I say, that use a little more data, they're starting to go into ancillary markets like Kansas City, Columbus, Birmingham, Alabama, and if another is it Knoxville, somewhere else in Tennessee, I forget the place, but they're moving out of like the core areas where they concentrated into some of these newer emerging areas that probably got a little less love during COVID, like Charlotte, Phoenix, Houston, parts of Florida, like those became pretty popular, and then they chase each other. And then now I would say like the sharper money is moving into some of these other areas.
And so, and are you able to use any predictive analysis to see that in advance, like from your data? Because obviously you saw, I assume, these motivated seller scores in 21, not very motivated, the sellers, right? They're very much a buyer's market in those markets, high. Right? Can you, what can you say? Can you say anything yet about what we can expect going forward? Are there places where they're hot today that, hey, 3 years forward, we're going to, have a problem or anything like that you're seeing right now through the data? Or is it just not enough kind of a history there to say?
Yeah, it's very hard to say, because there's still, it is, the turnover is still like slow, in the sense like there's a lot of listings and they need to basically remove capital to move somewhere else. So we're seeing Amherst is probably the most sophisticated operator that we're seeing, and usually is a first mover. That's probably our best signal. So it's those markets like KC, Birmingham, and Columbus that are more interesting, and then you would probably expect the others to follow. But first, they most likely need to move out of some of these more distressed areas. They're not full on distressed. There are parts of Florida that are severely distressed, like Cape Coral, Deltona, and some of these other places. While this like upper, like Pittsburgh, Buffalo, Columbus are like very steady. Like Buffalo is surprisingly, it's not huge in terms of the SFR, like the institutional operators, but it is actually the best performing market over the last 5 years, period.
Don't tell. Yeah. That's the thing, right? Yeah, no, it's interesting. So then are you able to see then, based on the data that you get, kind of the flow of funds by market and by buyer? Can you see the money leaving a market by, right? Because you're able to identify who's buying and who's selling. So presumably the underlying data is there. You could say, hey, this Amherst, for instance, they're pulling liquidity out of these three markets, and they're buying.
Yeah, totally. So it's just like the net.
Right.
Yeah, we have net acquisitions, dispositions by market.
Right. And then can you also presumably look at that filtered back to the buyer, right? If you have your high information buyers, the people that you see as first movers, you don't want to necessarily go with what the average person's doing. You want to kind of go with what the most I don't know the best word, the sharpest. Yeah, maybe the sharpest, or first. I don't know if you have to be sharp, but if they're first and they're usually right,
they probably see something.
Right. Yeah. Or, maybe they're wrong. That also gives you a signal like, hey, these guys are always first, but they're always wrong. So do the opposite. Yeah. You could kind of, because by the market is a little bit, it buries the intelligence of the buyer, right, inside of the intelligence of everyone else. Is that something you guys have access to through your platform?
Yeah, we have it. What we have is buyer,
right,
net adds and sells in a market.
So someone could take your data, that API, call the data, and then manipulate it from there.
See where people are moving.
Yeah,
Atlanta was like a large, like for example, First Key is the biggest listing, has the most listings right now. There's a little over 1,000 listings of these top 8 operators, but First Key is 30% of those, and they're super aggressive in Houston, for example, as well as Miami. The Miami area, and then then we see aggressive buying in Dallas, for example. So that's like another one that's kind of, it's a little newer, like out of Houston into Dallas. So that's one that we're watching pretty closely.
And are you able to see? I know you've been doing this in particular for 4 years, but presumably you have data going back further than that. Or does your data set start at the inception?
Kind of started there, yeah. It started because then we had to track. It was first it wasn't initially. There's a lot of work that went into identifying the true ownership, which is basically all these entities have a bunch of LLCs that then aggregate up to another larger beneficial owner.
Mm-hmm.
So a lot of that work came after probably like 2 or 3 years ago. So that's effectively, and this business only started in like the post great financial crisis.
Yeah, right.
So,
like there was no.
It's kind of like a newer industry that's going through its own new. It maybe like it went through like its first kind of downturn with higher rates. Like it was basically low rates. The whole industry functioned during a low rate period, and then rates went up. Like what happened? Liquidity's dried up. They can't move industry or inventory as fast. Same thing happened with Open Door, which we also track. So they're kind of right sizing to a new environment, which could again now be shifting if the rate cycle continues to come down.
Yeah. We keep our fingers crossed. And so right now, are you really focused? It sounds like on those larger owners. Do you have intelligence on the smaller, the mom and pops of the world and what they're doing and how they're moving?
We do, but it's not aggregated like the big ones. So there's and they're not all named. So I would say that the main things that we show are the large owners, and then the iBuyers, mainly Open Door, and then there's a bunch of, just given that they're known, publicly traded, some of them, it's kind of like a data integrity dynamic.
And if they're publicly traded, presumably you're able to pull their entities easily or relatively easily.
And you could check and then cross-reference with
and so it sounds like there are some markets that are on the way up that maybe weren't as hot before. The hotter markets are cold now, or colder, and maybe is it getting worse? Like where are we kind of in that process based on what you guys are seeing, or what the market's saying right now regarding that?
They seem to have stabilized. Like all the operators, like the rate of selling has kind of neutralized a bit. In the last quarter, they were net sellers, but at a slower pace than the first quarter. This quarter, everyone is still net sellers except for Tricon and Invitation Homes. Tricon and Amherst. Amherst is basically neutral. They're acquired like maybe 52 on a net basis, whereas Tricon has acquired maybe a couple hundred. So I would say it's like pretty balanced at large. It's not like a disaster. First Key is just very aggressive. We've written a specific report on this, but they're super aggressive again in Houston, Miami, Atlanta, and their motivated seller index is like at the highest it can be in those areas. So they're just trying to get right sized. They're trying to right size their exposure in those areas. So again, that's 30% of the listings for the top 8 operators. So it's something that we've just flagged and called out as interesting.
Yeah. And do you think that they are projecting something that they think is happening in the future, or are they just trying to catch up to things that have already happened? Right.
I think they're probably overexposed in those areas. They want to get out and kind of recycle the capital, because a lot of it's like, who is the incremental buyer? Like, who's the incremental buyer here? If you're trying to get out and like you're like the last in or you're mid in, but like Atlanta's interesting because they're all there. So who is buying all of the inventory such that they can exit and then move to somewhere else where they see a better appreciation opportunity or better economy for rents?
Yeah. And right. And presumably, like Houston, definitely a lot of insurance problems. Like obviously have a lot of operating expense exposure there. Hurt values. And I think a lot of people were drafting Dallas off of Houston Right? Like, oh well, Dallas is hot, and there's a lot going on there. Houston is not the oil and gas town it once was. It's diversified, and it seemed like a good story that you could draft off of that. And then I think there's been a bit of a repricing across the market. We've seen the same thing on the apartment side, where some of these hot markets with a lot of liquidity, or that had a lot of liquidity, including Atlanta, primarily northern Atlanta. Prices really ran up, and we're still trying to find a market really in the apartment space to see like, where should these deals be priced, and a lot of them are pricing at the debt at this point. If they were one, so
it's just a lot of money coming out,
right?
And then what, just not related to the institutions in particular, but we're seeing a lot of the, like, from a price perspective, a lot of kind of like I guess it would be called like the Rust Belt. Those prices have held in very well. I don't know if there's like smaller buyers here, but like Buffalo, Detroit, Milwaukee, Baltimore, Pittsburgh, Cleveland, like these are all very good performers over the last 1 year.
So far as relative price movements,
exactly. Relative price movements. Those like Buffalo, Detroit, Cleveland, Pittsburgh, and Baltimore are the top 5 1 year price moves in our what we aggregate for the majors. And it's Milwaukee. So those are kind of like northern town, a little bit northern, like, whereas the hot markets prior were Florida, Austin,
literally the hot market,
literally Florida, Austin, Phoenix, Atlanta, Charlotte, like those, like they've kind of, they're reverting in a sense.
Well, I think
those markets are super tight too. Like Buffalo it's insane. Like there's like the supply demand ratio is super tight.
Well, I think there was, just like with equities or any real security, you have defensive names and you have like high beta names, right? Like these high beta names are high beta when you go up and down, and these defensive, kind of properties or areas are defensive. They don't run up as much. They don't have as much liquidity in the, when the market's hot. You're not going to make as much money, through the cycle necessarily, but you're not going to have as much volatility potentially in price.
Well, that's the interesting thing, is because these places, like they actually now have surpassed on a 5-year basis a lot of the hot markets, because they're tighter. There's not as much room. Right, like you're in Florida, like let's build another development. Let's just build, so you get flooded with supply. Same thing in Austin. We were in Austin in 22, and like we went down there, and there was cranes everywhere, right? And like, so because they thought that all these places were also work from home destinations. So as that trend reversed, on top of, so you don't have the migration, and then you have a bunch of supply. It completely kind of decimated the pricing, whereas these northern belt places are just tighter. They probably weren't work from home havens, and they're also way more affordable, which is interesting, because you could have this dynamic of like, housing is super unaffordable, housing's my number one cost, maybe actually instead of relocating to work, I'm just relocating to live. Like I need to live somewhere, I'll take a different job so I can afford my house.
No, and it's everyone I think got on the train of migration, right, and kind of missed. I think there's always a miss every cycle where people like stop looking at the second order consequences of what happens when they're, yes, populations are moving, household formations moving to these areas, but then the builders get in, they start building, and then they build 10 times as much as they need, right? And then the reflexivity, right, of the whole market kind of just goes around, and then we're back to where we started again, and builders never built.
By the way, there's like the insurance premium now in Florida is like so much higher. So, that's like the idiosyncratic part of Florida that's a little bit different from the other places. Now, like it's not only how, maybe the houses are more affordable, but rates still suck. And then
Right.
have this like insurance premium that makes it like a non-starter.
Yeah, I guess it would have been I guess it was end of 22. We were looking at a property in the Space Coast, and the existing sponsor, I think, had about a $1,300 a unit insurance. We went to bid it, and it was the end of the year. The reinsurance market was basically closed. It was a horrible storm year. We were within 100 miles of the water, and I think the quote we got was like $3,000 a unit, right? And so like almost a tripling of insurance. Wow. And I was like, listen, we buy this property from you. We're basically going to destroy $10 million of value right out of the gate. So like, I don't know if this is the best solution, if it's best for you guys, like maybe we should just pump the brakes on this. They're like, yeah, no, it doesn't really make a lot of sense. I'll just keep the yield right here. And then, now we're getting quotes, not as low as 1,300, but certainly more like 1,500 to 2,000. Okay. Per unit, so definitely
like
we're
a 10% bump versus a 3.
Yeah, and it's less volatility, right? Less volatility in what that rate's going to be. So you're not trying to continually chase the market up. Oh, it's like, well, now it's 3,000, now it's 4,000. You can't get insurance. You got to put 17 different insurers together to get the one policy. But it's definitely. We're in the season right now, so we're hoping.
We'll see, right?
We're in the season.
We'll see if 1,500 holds.
Yeah, we'll see. Yeah, no, we just bought something in Panama City, and we thought it was going to be $1,800 a unit, and it was end up being $1,300, and so got that in, and but. Yeah,
I guess at a certain point they need business too. They can't.
Right.
Just it goes. They can't just be like 3,000, 4,000. They're like, okay, fine. We're just not going to buy anything.
Right. Well, it's like the HVAC contractor comes to your house. He's busy all month. He doesn't really want to do the job. He quotes you $20,000. You get the next guy to come in. He quotes you $7,000. You're like, well, what the hell? Like, how can it be $20,000 on this one guy and $7,000 the other? So yeah, there's a little bit of that going on. It's a limited market. There's not as many insurance. Insurance isn't as deep a market as we would expect or hope, I think. And I live in Boulder, Colorado, and we have kind of the same issue. We're right on the open space, and we get a lot of fires, and we've had floods. Surprisingly,
double whammy.
Yeah, so it's a double whammy. But it's hard to just find an insurer that will do it. So I guess tell me, we're coming up at the end of our time. Where is this going? What's the vision so far as where you want to bring this? As much as you want to reveal to the world, I'm sure you won't talk about the vision, whatever. But where is this going? I mean, this is a huge addressable market, right? This could rival other large futures markets. What do you see in the future, come 2030, or even 2 years out, whatever?
Yeah. So the goal is and our vision is to create a liquid market for real estate. We think there are a lot of participants and people that can benefit from it. Obviously, there's the retail element where people are priced out and they can get exposure, renters. There are, on the institutional side, which we think is very important, is the natural seller, given that they have on the ground risk. And put those two together. One is basically priced out. They need exposure. The other needs sell exposure or short exposure that they can't get anywhere else. Mm-hmm. And we think, given the rise of institutional ownership, that having a liquid derivatives market in real estate makes a ton of sense, and we're going to be there to capture it. So it's optimizing the instrument in order to be able to fulfill that demand, and then work on having a product that can be offered and regulated in the United States, such that institutions can participate as well as retail, and then we can market in a kind of a regular way fashion. I think we've done a great job up to this point. We've built a great team, and I really think we're just getting started on that front. And then Parcel Labs continues to hum, building trust, authority in the space, becoming the source of truth for real estate. Put those two things together, the source of truth and a way to get exposure, is really the vision for the Parcel ecosystem as a whole.
Awesome. That was awesome. That seemed way better when you said it than when I said it in the beginning. So I guess just last thing, anything you want to say that we haven't said that maybe people misunderstand about the Parcel, or that you just want to get out there as messaging as it relates to Parcel and what you guys are doing, or anything else like that?
No, I think this was great and comprehensive, Michael. Like, you let me speak and explain it to the best of my ability. It was a great conversation, talking macro, micro, insurance. So yeah, it was fun.
Excellent. Well, no, thank you, Trevor. Appreciate your time. Thank you for listening to Deal Flow with me, Michael Pouliot. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.